over the past year, the MSCI World Index is up about 26%, but this year it's up just shy of 3%. So is the rally we're seeing sustainable? That's the million-dollar question, the one we want to answer. And joining us now with his perspective is Jeff Palma. He is global equity strategist at UBS Securities. He garnered top ranking by the Global Institutional Investor when he was part of the firm's global asset allocation team. That, by the way, for 6 years. All right, Jeff is joining us now from his firm's office in Stanford. So, Jeff, talk to us about the rally and whether there's any sense of quality here, sustainability.
Well, I think somebody earlier summed it up quite well. There's a little bit of a relief rally going on the last few days. We've kind of cleared some of these initial hurdles on the Greece situation. Today's economic data out of the U.S. certainly better than feared, and I think sets up some sense that tomorrow's ISM number will be reasonably decent. And so I think it helps alleviate some of those near-term risk factors and some of the concerns about soft patches. Do I think there's a lot of conviction behind this rally? I'd say not yet, but a little bit more evidence of the economy stabilizing would certainly help that.
Now, of course, volume has just been pathetically weak, so that would certainly be one reason why you'd say there's no conviction. Anything else you're keying off?
Well, I think that's one. Number two, we've certainly seen our equity risk appetite indicator move lower over the course of the last few weeks. To us, that suggests that people are a little bit more in a risk-off mode. And I think we're just not seeing it across other asset classes as well. Commodity prices are just stable, but everything is more stabilizing as opposed to rallying very strongly.
Now, on up days, are people buying less stock than they are selling on down days? Because that would be a red flag.
It would. I mean, just on trying to eyeball some of those numbers, it seems like some of the higher volume days were a little bit more in that sell-off period when people were in that risk-off mode. I think mostly what we're seeing here, Adam, based on some of those volume numbers, is people are just sitting on their hands until they really have a better sense of what that big next move they want to do is. I think, in general, people still feel reasonably optimistic about the medium-term views, and so they are just looking for that opportunity to buy in more conclusively.
Okay, what's your big next move? What do you like right now?
Well, we've recommended all year, regardless of some of these more tactical concerns, moving to a more balanced allocation between cyclical and defensive sectors. As we reach this more mature phase of the cycle, we think that a more balanced view than just a pure cyclical view makes sense. So the sectors we like right now are technology, a little as per your conversation earlier. We like healthcare and we like telcos. And within regions, we like the emerging markets still.
Now, I don't see financials or banks anywhere near that list. I assume that is on purpose.
It is. I mean, at least on a global basis, we're still quite concerned about the situation in Europe, as you might expect. We're concerned about where capitalization levels are. I would highlight our global banks team and our U.S. strategy team are overweight banks in the U.S. We think that the valuations here are reasonably attractive. But I think the key in the U.S. Is mostly about starting to see some loan demand come through. But otherwise, on a global basis, it's been a very, very frustrating part of the market.
Yeah, it sure has. But by the way, what's your view on housing?
Well, our view on how we do think it's bottomed. There's some really good positive early signs. Rents are picking up. We think that credit conditions are becoming a little bit easier on the financial side. That all should help provide a bit of a floor and a bit of a bottom to the housing market. Whether we see big increases from here is debatable, but at least from an economic perspective, seeing things flatten out, I think, is critical.
You know, people are always talking about emerging markets and the power of China, GDP growth over there of whether it's 9.5% or 10%. What's your view on China and how it impacts stocks here at home?
Well, I think the irony about the China situation is that we went from worrying about growth being too strong earlier in the year and driving inflation pressures to whether we're going to be in a hard landing now. Our view is that we're in a soft landing situation in China where things are going to moderate. I think China provides a very important source of global demand at this point. It's obviously one of the faster, more important growing parts of the world. As long as growth holds up in China, I think that's pretty supportive from a global economic perspective.
And your target, Jeff, for the S&P at the year end?
Our U.S. strategy team still has 1425, which is, pretty reasonable upside from here, about 10%. That would be driven a lot by earnings growth holding up and a little bit by some PE multiple expansion from where we are today.
Great. Jeff Palma, UBS Securities, thank you very much for joining us. Great perspective. We're happy to have you anytime. Well, up next. Thanks.